morning, everyone, and welcome to the Naples Money Managers Money Matters news you can use on August 24th. I think I got it right this time. Marcus and I switch on and off, kind of being the MC of this, so I'm going to be here for the next couple of weeks doing it, and then Marcus will come back and take over. And Dennis Nelson's going to join us today, as well as Marcus Bickle. And what we will try and do is keep you on the edge of your seat with the newest and latest market information. So we're going to go right to Dennis with that for now.
Well, as everybody knows that's been listening to me for a while, I really like to look at sectors to give us clues as to what's going on in the market and see where the money flows are going. And by that you look for the sectors, you watch what's going on in the broader market rather than individual stocks. Up until this point, for the whole year, the market has basically been 4 or 5 high-tech, high value type stocks like Amazon, like Apple, Google, Facebook. If you bought those stocks, you were at the forefront of the market. But now we're starting to see what looks like some broadening out of that focus on those few stocks. And this, to me, is really great to see. This tells me there's a broader strength going on in the market. So we're starting to see defense stocks come up. Drug stocks are moving, are catching some action, but particularly we're seeing it in small cap growth stocks. They have really turned the corner, and to me this says that money is flowing into smaller companies that are more local, more likely to be local U.S. type companies, and maybe making a prediction as to when this market and when this economy is really going to start swinging around.
Can I jump in for a second here? So I'm looking at some of the money manager reports that we get, and they're talking about exactly what you're talking about, and the fact that it kind of makes the managers like us, which are active managers versus passive managers, which means you just buy a basket of stocks and leave them there. They look brilliant right now because they're so overloaded in these top 5 stocks, whereas active money managers like us sometimes don't look that smart because we're not doing as well. However, when you look at right now, it says since January, the top 5 stocks in the S&P have earned a positive 33%. 33%.
Is that incredible?
All the other, the 495 others are down 5% on average. So when you look at that right there, I mean, I guess it's really a feather in our cap because our returns are up. What is the latest Mapato growth in income? What was it? Do you remember?
Yeah, it was a little over 5%.
Yeah, a little over 5.
Okay, I thought it was a little more than that, but I thought it was a little closer to 7 last Thursday. But anyway, regardless, with our active money management and our lower risk style that we use, we are still ahead of 495 of the S&P 500 stocks. Granted, we're not ahead of the top 5, which are up 33%, but it talks a lot, and these two managers in particular are also talking a lot about exactly the same things that you are, and that there are other companies out there that are plays on these larger stocks where you can take part in what's happening there without sinking 40 or 50% of your portfolio in 5 stocks.
Which brings up something else that we're just starting to see, and I hope it turns into a trend. And I know a lot of money managers would say that splitting stock really makes no difference in the value and the prospects for a stock. But I'll tell you what, I really would like to see Amazon or Apple, which is going to split 4 for 1. I'd sure like to see that at $125 a share. That gives a lot of investors more ammo to spread their money around to other stocks. Tesla also announced a split 5 for 1.
Right.
That's to me that's great to see. I love it.
It is. It's good to see, and I think a lot of the people are starting to talk on like CNBC, not CNNBC, CNBC, the Financial News Network. Okay, just so I get them straight, because every time I say that, somebody says something to me. And they're talking about the fact with options, you do need 100 shares of something.
Right.
So if you're really trying to use a conservative strategy, which is the covered call strategy we talk about, we need at least 100 shares. Well, we can't buy 100 shares of Amazon for most people. In our ultra portfolios, we can. The ultras for those people have more than $5 million in that particular portfolio. But other than that, we can't do it.
It's impossible. 100 shares cost you $325,000.
Right, and so
That's crazy.
our rules say we can't have more than 5% in any one stock position. Well, that's certainly not what's happening in most of these weighted portfolios. They're overweighted, way overweighted, 20, 25, 30% in some of these stocks, right?
Right.
So if the splits help a lot of people get into these positions and in a more conservative fashion as well, I think that's a big plus.
Yeah, I really like to see this happen.
Yes, I mean, I don't care what they
And
say.
I hope more companies do it.
Yeah, splits are positive. You know, you're right, the numbers are all the same. Psychology's different, and that's what it's all about.
That is what it's
All right, are you all set?
All set?
Okay, we're gonna have Marcus Bickle come back and join us. No idea what's gonna come out of his mouth today. Probably some blah 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 from babies.
Hi everyone.
Are you gonna, what do you call
Baby
it?
talk, babble? No,
Yeah.
I get enough of that at home.
No, all you have to do is scream.
Oh yeah.
Can
A lot
you
of
do
that
that?
too.
Can you scream?
I could. Ah!
We all of us who have been around kids or had kids know the pain you suffer.
I'm just a little tired.
Well, that's pain. That is pain. Well, how old is
He is 2 months now.
I forget his name.
Jonah.
Jonah. I'm sorry, guys.
No, it's okay. He's still new.
It's 2 months.
2 months.
We
yeah.
saw him on Zoom the other day. It looked like he was 20.
He's big. He's heavy. All he does is eat.
That's good. Anyway, I got you way off track.
No, it's
What you
okay.
gonna talk about?
So I wanted to kind of dovetail off of what Dennis said a little bit about the splits are really important because he talked about some of the real high flyers like Amazon, Apple, but honestly, even in our conservative portfolios, we see it's very hard to find a stock that's less than $200-300.
Right.
It really is. Anything you want to own is expensive, and anything you don't want to own isn't. And so you have to ask yourself, if something is trading at a reasonable price, why is it? And that's kind of what we talk a little bit about the value trap. You know, if something isn't $100 a share, why?
Right.
Especially in this market where it does feel like people really kind of brigade into or put a lot of momentum into a good story.
And there's a lot of these IPOs that start initial public offerings, brand new stocks coming to the table. They've stopped for a while. They were dead there for March
Absolutely.
and April. Now they're coming back. A lot of new money coming in. Forget the name of it. It's a corporate funding where then they go out and they fund these.
Oh, business development programs?
Yeah, but it's a specific name. I might remember it, I might not. But there's a lot of money coming into this area. People looking to find the next big Amazon or the next big Tesla,
Oh, yeah.
whatever.
You talking about SPACs?
Yes, I am talking about SPACs. Dennis just piped up. Yes.
SPACs.
What is Special Participation Acquisition Corporation.
Something like that.
Yeah, I know it's a special an acquisition
That's why you
corporation.
hate acronyms. So.
Yeah, I hate them all. I hate acronyms, right? So a lot of those are coming to the table and making this market feel like the 1999 again. And you weren't here, Dennis was here. But I know that there's some element of different that these companies at least have revenues,
Sure.
unlike them in 1999.
But Don, you bring up a really good point, and it kind of it goes into our portfolio very well, especially our Mapato portfolio, our covered call. So what I really wanted to talk about here was, as of last Friday, was an expiration date for our options.
And what does that mean, an expiration date?
It means that they would either call the contract from us and take the stock because it had satisfied the contract, or it expires worthless. We keep the stock, keep the premium. So because it was the third Friday of every month, that's a typical expiration date.
So let me just stop. So
yeah,
the
go ahead.
expiration date means the contract we have on that stock expires. It goes away. And it goes away in one of three ways. It either goes away by they take the stock from us, or it goes away because the stock isn't worth taking it from us. We get to keep the stock and they lose all their money, right? That's the third
Absolutely.
way. And the third way is we could buy it back on some time around then if we chose to.
If we still really wanted to hold on.
But
to
the
that
real bottom
position.
line, expiration means contract expires.
Yes.
Boom.
And that was last Friday. So we see a lot of movement in the accounts on those days. A lot of our stocks were called, some expired worthless, so we had to hold that position. And the reason I bring that up, especially in what you're saying with the 1999, 2000, is this gives us something that Don always says is it pulls you out when you want to be in and puts you back in when you don't want to be.
Right.
That's really important, especially in a market like this where things have kind of diverged a little bit. You know, we're looking at 10% unemployment on Main Street, but the Wall Street's posting record highs. So as a smart investor, you want to be aware of that and try to be nimble. And because of the options pulling us out of the market at these particular times when things are really, really hot, it gives us another chance to look and go, well, do we want to be there?
Right.
Why are we there?
Right.
And that's really smart investing, I think.
No, I agree. I was telling Dennis just before we sat down, I'm getting ready to put a contribution into for my husband's SEP IRA, and it's an annuity. And so we're thinking, and by the way, there's been some good press about annuities lately. You can talk about that another time. So I'm thinking, do I wait because the market's really high? Do I wait and lock in the guarantee at a high level, or do I try to put it in later, wait for the market to drop, or do I do it a little bit at a time over 3 months? And Dennis said, speak up, Dennis.
What did I say?
He said it's never good to wait.
Yeah, shouldn't try to time
Oh,
it.
and that's true. When I got in the stock market originally in 1974, it was 550 on the Dow.
Right.
Now, there's been lots of ups and downs, but I'll tell you what, if you'd have just gone in, you'd have got that.
So basically, you just have to live long enough. I mean, that's kind of the deal. Because I came in the market was not even 1,000.
And it's now 28,000 for the record.
Right. So, all right. So I think we're going to wrap it up. But I think a lot of people are worried right now because the market's going really, really high. And we want you to know that we have mechanisms in place.
Absolutely.
And we want to share those with as many people as possible. By the way, if you scroll down you'll see a place where you can share our video, and you'll see also a place you can subscribe. So we would appreciate it if as many people could subscribe as possible, and if you could hit the share button and share it with as many people as possible, that would be phenomenal, and we would thank you profusely for that. So
Absolutely, thank you.
have a great week.